One of the things I love most about being an investor, besides earning money of course, is to constantly learn more about new companies, new technologies, and to refine and adapt my investment strategy based on facts and statistics. For these reasons, I was very excited when I found the Guide to the Markets 2024 that was published by JP Morgan end of December. But quite quickly, I found so many insights and facts that are absolutely relevant for investors, and so I decided to switch to the US version and make a video about it. Immediately, I noticed quite some difference between both versions. While the US version jumps to stocks and the stock market right away and only focuses on the general economic data as kind of an afterthought, the EU version focuses much more heavily on general and global economic data and also goes into much more detail of each region and country and even includes some Asian countries like China or India. Outside the YouTube space, I am a physics engineer and curious by nature. I've always wanted to understand how things work and affect each other. So my curiosity got the better of me and I decided to go through both reports and combine and sum up the most interesting facts for you. So I went through more than 170 pages of combined reports, but I didn't stop there. While I mostly used the UK version of the European report to make it more accessible, I noticed some slight differences between the German report that I read before and the UK report. So in the end, I couldn't stop myself and I also compared the both of them to give you a full overview of all three reports. But don't worry, we'll not go into every detail of each report. Instead, I'll try to sum up the facts and statistics that I found most interesting and most applicable for private investors. So if you are like me and also like a fact-based approach on long-term investing, and if you are interested in the data, facts and statistics of the last 40 years that directly affect our return, grab a snack and a beverage, get yourself comfortable, and let's jump in. So at first, let's have a look how the economy is forecasted to behave in 2024. And if we have a look at the different regions, we can see that actually in all regions except the Eurozone, the GDP growth is expected to go down from 2023 levels. Only in the Eurozone it should stay roughly the same as in 2023. But JP Morgan doesn't expect any increase in any of the regions. For a long-term investor with a globally diversified portfolio, it is not only important to know how the GDP of each region will grow in the next years or next year, but also how the current share of the GDP by region looks like. And if we look at the right-hand side of the slide, we can see that in most regions, the share of the global GDP is actually declining. Especially in the US and in the Eurozone, the GDP is declining quite significantly since the 90s, in Europe even longer. The biggest benefactor of this was China. And China had an almost exponential growth of their GDP share over the last decades. Only recently, in the last couple of years, we can see that it dipped and went flat right now. Over the next years, it is also expected to decline again a little bit, but for the time being, it seems to be flat. The second region that could win here is actually India. And even though India's share of the GDP grew steadily over the years, it is still on a very low level and the growth also has not been as quickly as China's GDP. Everybody has been talking about the inflation over the last 2 years. And if we look at the statistics that reflects 2022 and 2023, we can actually see that over most regions except Japan and China, the inflation has really been quite increased compared to the years before. But recently, in the second quarter of 2023, we can also see that in most regions, the inflation went down quite significantly again. And right now, in most regions, it sits at quite an acceptable level again. But of course, we also need to see how this will develop over the next quarters and next months. Directly linked to the inflation, the interest rate has also risen in most regions over the last 2 years. The Fed and the European Central Bank have already stopped their hike and are currently keeping the interest rate flat. And they are actually expected to lower the interest rates again. It is not clear though when this will start. And this is also reflected by the data of JP Morgan. Here we can see that the market expectation for the central bank policy rates in all regions except Japan is expected to lower the interest rate again by quite a bit. In most cases, the expectation is that it will be lowered by about 2% and should be around the level of 2 to 3% in 2 to 3 years from now. There are many crash prophets out on YouTube and in the podcast space, and you hear them telling all the time that the US and all the central banks will go bankrupt, that they cannot pay the debts anymore, and that the economy is basically screwed. If we look at the graph on the right-hand side here, we can see that the balance sheet of all central banks combined has reached a peak around 2021, 2022 and is already going down again. The forecast is also that the balance sheet of all these central banks combined should be deleveraged even further in the next years. But the balance sheet itself is not the most important topic, I think, that we need to look at here. What is even more important from my point of view is not the real balance they have, but the interest they have to pay from this balance. And if we look at the next slide, we can actually see that the government debt as percentage of the real GDP has risen over the last years in all of these regions. And this reflects a time frame from 2000 until today, so for the last 23 years. And the forecast is also that it will increase a little bit again. That is also kind of natural because the interest rate over this time period has been quite low, so the government could load up on new cash while keeping their interest payments on quite a low level. And that is actually also what we can see on the right-hand side here. This is the government interest payments, also as percentage of the real GDP. In the US and the UK, it has been almost flat also over the last 23 years. And only very recently it has increased in the UK, and there is a trend in the US that it might increase over the next years. Probably that comes with a rising interest rate also. If you look at the Eurozone, the EU, we can even see that the interest payments as a percentage of the GDP has declined over the last year. If you look at the data of the labor market, first in the US, we can also see the trend of the last 50 years here. And the unemployment rate, marked in the gray graph here, sits on a very low level, almost the lowest that it has ever been in this time frame. And if we look at the Eurozone labor market actually, we can also see the same. Here we also see the gray marked line, which is the unemployment over the EU. And again, over the last, in this case, it's only last 25 years, but over the last 25 years in this time frame, it is also on the lowest level ever. JP Morgan also shows the data of the housing market in the US in their report here. And we can see that compared to the last 15 years, the sales of new homes and existing homes has decreased also. We can see quite a drop here from the numbers from 2021. And I would assume that the biggest reason for this is, of course, the higher interest rates that we have today compared to the last 15 years. The US housing inventory has also decreased and is sitting at the lowest level right now for the last 40 years. In the consumer balance sheet, we can actually see that the total assets of consumers, private persons, consists to 1/3 of houses, to 41% other financial assets, but deposits and pension funds also make up for quite a bit. If we look at the consumer liabilities, we actually see that mortgages make up 66% of the personal liabilities here. Honestly, I am not so sure what to make of this statistics, because my expectation would be that this looks quite a bit different if you compare high-income households with low-income households. What is definitely interesting though is if you look at the debt service ratio, basically the debt payment as percentage of the income. This sits very near the lowest level of the last 40 years. The trend for early delinquencies has been quite stable over the last years. We can see there is a huge drop in the student loan delinquencies over the last years, but there definitely is a worrying trend when we look at the auto and credit card loans. Because in this case, since 2021, the trend is rising quite quickly. So that means that more people cannot afford their loans anymore compared to 2 years ago. What I find interesting though is if you look at the personal saving rate, here we can see that even though Most households should have more money available right now. The personal saving rate has decreased over the last decades. And even though it has peaked during the pandemic, right now it sits at a very low level of 4.6% compared to the long-term average of 8.6%. So the personal saving rate as of today is only half of the long-term average. Before we look at the detailed data of the stock market, let's try to estimate the very, very long-term forecast for the economy. And this can be done by looking at the population growth. And if we look at the data of the US, in the next couple of years until 2050, it should still increase by a bit. But after that, it should mostly stay stable, maybe increase a little bit. If you look at the Eurozone, we have already reached the peak of the population. And in the next decades, it's only expected to go down from here. The data of the UK actually looks quite similar to the US. So here again, it should increase over the next couple of years, the next decades maybe even, but after that it should stay stable, and in the long run it might even decrease by a little bit. The trend in China looks quite different compared to the other regions. Here we can also see that similar to Europe, we have already reached the peak population, but the decline over the next decades is much more severe than what we can see in Europe. And by 2019, the population should almost halve and reach only a value of 800 millions compared to the 1.4 billions that we have as of today. If you did like the video so far and if you found some of the information helpful, please consider leaving a like or even subscribing to the channel. Let's jump into the details of the stock market now. The first thing that JP Morgan focuses in their report is actually the valuation of the stock market. And here we can see the valuation of the S&P 500, and the 30-year average has actually been sitting at a PE ratio of 16.5 times. This is actually the forward PE ratio. Currently, we are sitting at 19.51, so this is around 1 standard deviation above the 30-year average. Also, if you look at the other valuation metrics, we can see that every single one of them currently sits above the 30-year average. For dividend investors, it's also very interesting to see that the current average dividend yield of the S&P 500 sits around 25% below the 30-year average. This has not been always the case. When we look at the graph here, we can see that the S&P 500 had times where it sat quite a bit above the average, even higher than what we have today, but there also have been quite some times where it has been sitting below the 30-year average. Especially around the 2010s and when we had the financial crisis, the PE ratio was quite a bit below the 30-year average. So today, the S&P 500 seems to be valued a bit high. The valuation of the MSCI World, also measured in the forward PE ratio, also sits a bit higher compared to the 30-year average. Here we can see that the multiple actually sits at 17.6 times and the average sits at also 16.3 times. So it is also a little bit elevated, although definitely not near the levels of the S&P 500 here. This valuation premium is also reflected if you look at the weight of the MSCI All Country World Index, where more than 60% of the companies of the stocks in this index are from the US. Emerging markets make up only around 10% here, Europe ex-UK makes up 12% and Japan around 5%. On the left-hand side we can see the 50-year returns by region. Here we find maybe one of the reasons for this increased valuation of the US. And the annualized returns in the US as of the S&P 500 have been quite a bit above the average of all countries. The only country that has beaten the US over this time frame is actually Taiwan. And the lower end of this return is coming from emerging markets like China or Brazil. If we go a bit deeper into the details and look at the valuation of the different regions, we can see on the left-hand side here, we have in gray, it's marked the range since 1990. The green bar is the average since 1990, and the blue dot is the current valuation. And here we can see that also all over the world, what we also just saw in the MSCI World, the valuation sits a little bit above the long-term average, but this higher valuation of the MSCI World is only coming from the US. Only the valuation of the US is sitting above the average. In all other regions, the current valuation actually sits below the long-term average. We can also see this on the right-hand side, where we see the discount between the US market and other regions. In purple, for example, is Europe, orange is China, and blue is the UK. And in all of these regions, the difference in valuation compared to the US has increased over the last decade. In China, it is most severely. The valuation in China compared to the US is the lowest right now. But even the valuation of Europe is around 30% cheaper than the valuation of the US right now. And we can not only see this in the valuation of the PE ratio, here again on the left-hand side, but we also see this in the difference of dividends when we compare the MSCI All Country World Index with the S&P 500. Basically what they did here is they subtracted the dividend yield of the S&P 500 from the MSCI All World Index. Here we can see that the difference of the dividend yield of the MSCI All World Index compared to the S&P 500 sits almost at their highest value they had over the last 20 years. So especially for dividend investors, it might be interesting right now to look outside of the US for high yield dividend companies. And one of the reasons I think where this is coming from is if we look at the different segments. And here we have the global comparison of the sector weights. And what we can immediately see is that in the US, the gray bar, we definitely have quite a huge weight on the IT sector compared to all other regions. In Europe, we can see we have very strong industrial sector, very strong healthcare sector, also quite a strong financial sector. These sectors are all lower valued compared to the high growth IT sector. Also, if you look at the emerging markets, we can also see that the financial sector is quite highly valued. The consumer discretionary sector is quite highly valued, and also the communication sector. But this US focus on the IT and tech sector with a very high growth, but also a very high valuation, definitely has an impact on the overall valuation of the US and of the S&P 500. Another reason for this could also be that companies with a higher growth also usually have a higher valuation. And if we look at the earnings per share growth estimation for the next year, the US sits a bit above the world average and quite a bit above the European expectation actually. The emerging markets and China are still expected to grow quicker than the US, but here the risk is also higher. What I also found very interesting is if we look at the profit margins on a 12-month trailing basis. Here we can see that the US decoupled from the rest of the world after the financial crisis and has improved their profit margins very significantly compared to the other regions in the world. I mean, the overall trend over all regions is going up, but the US definitely has a premium of profit margins here. I would expect that this trend to higher profit margins will also continue over the next years, maybe even the next decades, due to higher automation, more focus on AI, and maybe also a switch to higher margin companies like the IT or software companies. There is always the ongoing discussion if the 7 biggest companies in the S&P 500 are overweight or if they are worth their share. And if we look at the statistics here, we can actually see that during the .com area in 2020, the index weight of these 7 biggest companies sat a little bit lower than 20%, and the earnings contribution of these biggest 7 tech companies, which were totally different companies than what we have today, have been sitting around 7% back then. Today, the biggest 7 tech companies are sitting almost at 30%, but the earnings contribution also sits at around 17%. So the gap between this market cap and the earnings expectation of these 7 biggest companies has actually decreased over the last 20 years in the S&P 500. And if we look at the graph on the right-hand side, we can also see in green the earnings expectation of the S&P 500 without the biggest 7 companies, and in blue the earnings expectation of only these 7 biggest companies. And here we can really see the difference in growth and in earnings expectations. So here these seven companies make up a huge part. Again, change of 30%, growth of 30% in earnings. So this really shows that these 7 companies have really driven the returns of the S&P 500, at least over the last year. There is always a big discussion of what investment strategy is the best, value or growth. And if you look at the data of the last year and the 10 years, Please keep in mind this is only 10 years, and that is quite a short time frame when compared to most of the other statistics in this report. And here we can see that the 10-year annualized returns of large cap growth companies have actually been the highest, and the returns of small cap value companies have been the lowest. Last year in 2023, the trend actually was the same. Here we can see the large cap growth company had a return of 42.7%, and small cap value companies only had a return of 14.6%. Although in this case, large cap value companies had an even smaller return of 11.5%. If we do look at the values, since the market low in March 2020, large cap growth company and small cap value companies have performed quite similarly. Here, the difference between large cap growth and large cap values companies is also not that high. And the worst performer have actually been small cap growth companies. One of the reasons might be that small cap growth companies are also usually the ones with the highest debt rate. Oftentimes they are financing their growth with their debt. And with the rising interest rates over the last years, it has definitely been a tougher environment for these kind of companies. But another reason for the outperformance over this time frame of the large cap growth company could be the difference in valuation. And if we look at the right hand side here, we can actually see the current PE ratio as percentage of the 20-year average PE ratio. And in case of large cap growth company, the current PE ratio sits at the highest level compared to the 20-year average of 140%, compared to only 97% of small cap value companies. So this annualized growth, this annualized return of these growth companies does not only come from the outperformance of their business, but also from the valuation increase of this kind of companies. Here we can also look at the real PE values compared to the 20-year average, and also compare this to the average of the S&P 500 of the last 30 years of around 16%, 16.5% actually, that we saw before. Large cap growth companies have always been valued a bit higher, and large cap value companies actually have been valued a bit lower. And again, as of today, also large cap value companies are much lower valued compared to growth companies, and the value growth has also been not as high and only sits at 108%, so only around 10% higher compared to the 20-year average PE. So one might argue here again that large cap growth companies are especially expensive at the moment, and because the biggest company in this category are actually sitting in the US, they are also driving the valuation of the US. But what exactly does this valuation mean for our return expectations for the next years? When we look at the statistics, in the first graph, JP Morgan plotted the forward PE ratio with the subsequent 1-year return in the S&P 500, so focus on the US stocks here. And we can see that it's basically all over the place, but the return here plotted on the y-axis is actually higher for lower valued company when compared to higher valued company. And if we look at the 5-year annualized returns, we can see that the field gets much closer now. Now the trend is much more visible. And again, the 5-year annualized return of lower valued company is quite a bit higher compared to the higher valued companies. And you can see this is from the US report. Unfortunately, I didn't see this number in the US report, so I'm jumping to the European report. That's why the graphs do look a bit different. In the European report, we can actually also see the 10-year return. And in this case, the trend is very clear. It's again also for the S&P 500, so no worries. We are not comparing apples to oranges here. The current valuation is plotted in the green bar here, actually between 19 and 20. And here the trend is very clear. Companies in the S&P 500 with lower valuation have much higher 10-year returns compared to companies with a higher valuation. So if your portfolio has an overweight on these highly valued growth companies, it might make sense to shift a bunch of these stocks to value companies with a lower valuation. Of course, as always, past performance is no indication for future returns, but the statistics speaks a very clear language here. In the beginning of the video, I already mentioned that the Fed has increased interest rates a couple of times during the last years. And here we can see the S&P 500 returns after the end of the last Fed hiking cycles. in the graph on the left-hand side here, we can actually see the returns of the S&P 500 after the Fed has actually ended these hiking cycles. This happened 6 times over the last 40 years. And in 4 of these 6 cases, the S&P 500 has actually performed quite well in the subsequent 24 months, so in the subsequent 2 years after the Fed ended the hiking cycles. And only in 1 of these 6 cases, the S&P 500 has actually been in the negative, which was after the dot-com bubble. And in 1 case, the S&P 500 was around 0 return. The current cycle is actually marked in the orange line here, and we are just at the very beginning of this cycle. So I'm very excited to see what will happen over the next 2 years and what kind of returns the S&P 500 actually brings in this case. Before we come to the end and sum this up, I also briefly want to mention the life expectancy as of today. And here you can see that persons with the age of 65 today have actually quite a high expectancy to reach 80 years or higher. It's around 70%, a little bit lower for men, a little bit higher for women. And if you look at the 90-year range, around 30% of the people that are 65 today are expected to reach at least 90 years or older. In a couple's household, today already more than one person is expected to reach the age of 90. Most of you guys watching this are probably younger than 65, and this life expectancy will only go up over the next years. So at least for myself, I expect there's a good likelihood that I reach an age of 100 or maybe even older. And this slide I only found in the German report, so please excuse the German language here. Basically, this plots the compounding effect of 5,000 euros with a return of only 5% per year. And here you can see the gray line is if you start investing one time 5,000 euros with an age of 25, and the blue line indicates if you only invest 5,000 euros once with a return of 5% with an age of 35 years. And in case of 35 years, you will have more than 350,000 euros by the age of 65 and almost 640,000 euros if you invested these 5,000 euros with an age of 25. Please keep in mind, this is only a one-time investment of 5,000 euros and it is only a return of 5%. This is lower than the average return of the S&P 500 and in the MSCI World. On the right-hand side here, we can see what happened if you invested 5,000 euros in the MSCI Europe in '86. And the gray line here again indicates the reinvestment of dividends and the blue line without reinvesting the dividends. And even if you only put the 5,000 euros in the MSCI Europe once, by today you would have 33,000 euros and you still get the cash flow of the dividends each year. If you did reinvest the dividends each year, you are sitting at 104,000 euros as of today. If you would have reinvested the dividends, you would be sitting at 104,000 euros as of today. And again, this is only with a one-time investment of 5,000 euros. As we could see on the last slides, our current life expectancy is already well within our 80s. So it gets more and more important to manage our retirement, and the longer we live, the longer we actually have time for compounding. But if you're watching this channel, you're probably already investing yourself, so this is likely no news for you. Today's format is a bit different than what I usually do. If you did like the summary and want to dive deeper into these reports, I put a link of all 3 of them in the description below. And guys, I really put a lot of effort and time into the analysis today. So if you did find it interesting, or if you did learn something new for your investment strategy, please hit the like button or even subscribe to the channel. It doesn't cost you a bit. And if this kind of analysis is something that is interesting for you, you can also leave me a comment down in the comment section. I'll definitely consider doing this more often in the future. So thank you very much for watching, guys, and see you next week.